Here is a striking question to start with. What do you do when a company with over $30 billion in annual revenue gets called too cheap to ignore by major financial analysts? That is precisely the situation with Salesforce, ticker symbol CRM, as of today, the 11th of July, 2026. After a brutal stretch that saw the stock shed roughly 45% of its value last year, something has shifted. Multiple Wall Street desks have quietly been piling into their buy cases, and the chorus is growing louder. This is not speculation, this is a pattern of institutional conviction that individual investors simply cannot afford to miss. Just this week, on the 9th of July, 2026, Yahoo Finance published a detailed piece making the case that Salesforce is becoming too cheap to ignore at current valuations. That follows Needham's firm decision in June 2026 to maintain its buy rating on the stock, a signal from one of the more respected boutique research houses on the street. When you also factor in that Thursday's 9th of July analyst roundup from 24/7 Wall Street specifically named Salesforce as one of the best research calls of the day, you start to see a consistent pattern. This is not one lone voice, it is a convergence of independent analyst judgment all pointing in the same direction. The core argument for Salesforce right now is valuation. After falling nearly 45% last year, the stock is trading at a meaningful discount relative to its historical price-to-earnings multiples and its peers in the large-cap software space. Analysts who have re-rated the stock bullish are pointing to the fact that Salesforce's fundamental business, cloud-based CRM software, AI-driven sales tools, and its growing data platform, has not deteriorated in line with the share price. Revenue growth has remained resilient. The market, in other words, has been pricing in a level of pessimism that the underlying business simply does not justify. That gap between perception and reality is precisely where long-term alpha is found. Morningstar included Salesforce in their April 2026 list of 5 stocks to buy before growth stocks come back, and the timing of that call is looking increasingly well-judged. The broader environment for growth stocks has been challenging, but as interest rate expectations shift and enterprise technology spending stabilizes, the headwinds that hammered CRM are beginning to ease. Analysts at TIKR pointed earlier this year to structural factors supporting at least a 15% rebound for the stock in 2026. With artificial intelligence features now deeply embedded in Salesforce's product suite and enterprise clients renewing and expanding contracts, the revenue story is becoming cleaner and more predictable. Looking ahead, the next major catalyst for Salesforce will be its upcoming earnings release. Analysts are watching closely for margin expansion, AI product adoption rates, and any forward guidance that signals confidence from management. Institutional interest is already building. Schickier Asset Management, for instance, disclosed a $2.75 million stake in CRM in July 2026, a small but indicative sign of money moving back into the name. If earnings deliver even modest positive surprises, the stock could see a meaningful re-rating upward. For long-term investors, the risk-reward at current levels looks increasingly asymmetric. Here is the clear bottom line. Salesforce is a $30+ billion revenue business, dominant in its category, actively integrating AI, and trading well below its historical valuation norms. Multiple credible analysts, Needham, Morningstar, and independent research desks, have independently arrived at the same conclusion: CRM is undervalued and presents a compelling opportunity for investors willing to look past near-term noise. If you are building or reviewing a large-cap position today, the 11th of July, 2026, Salesforce deserves serious consideration. Do your own due diligence, set your entry level carefully, and keep watching those upcoming earnings figures closely.